Good morning, everyone. Thank you for joining us today for our Cash Flow Wednesday event. Today's event is titled Mining Your Business for Hidden Cash. My name is Paula McCain, and I'm one of the senior advisors here at the Small Business Development Center. Today is National Cherry Turnover Day. And who does not want to celebrate that? Just asking. So. The SBDC is the leading provider of assistance for small businesses. We are grant funded, and because of that, we can offer our services to you at no cost. Services like today's webinar, Mining Your Business for Hidden Cash. A quick reminder, we will be recording this webinar, then adding it to our YouTube channel. Today's webinar is interactive, so please feel free to raise your hand. You can use the small button at the bottom. If you have a question, put it in chat. We'll be monitoring chat, or just ask your question, unmute and ask your question. Our presenter today is Mike Milan, AKA Cashflow Mike. He's a seasoned entrepreneur with over 20 years of diverse professional experience in strategic planning, finance, and sales. He's developed 14 startups himself, and made them into well-established businesses, and that's where he got the name Cashflow Mike. He's an Army veteran with an MBA from Baylor University. He's an author of 3 books focusing on using financial statements to find hidden cash in businesses. He created a financial management training program called The Clear Path to Cash, and several different fintech software products like Cashflow Tool, Finagraph, and the Clear Path to Cash. Welcome, Mike. Thanks for joining us.
Hey, who wouldn't want to be here on Cherry Turnover Day?
I know, right?
You
Right.
got a day for every time I'm here. There's a day that's happening. Right? So that's real good stuff. So, hey, live from San Antonio is Cashflow Mike, and we are going to get into some good stuff today. I saved the best for last. So if you've been watching this series, this is number 4 out of it, and this is the best one. This is the one I hold back just a touch, because once you learn it, you are going to change your financial life. It just definitely will. Now, if you remember last week, it was heavy. Remember all that heavy forecasting we did? Well, we're not going to escape math. It's just going to be easier math. You good? You ready? All right, here we go. Let me start to share. Share. And I think everybody see my stuff.
Got it.
Okay, so as part of this series, I sent out a workbook, right? So if you noticed in the workbook, if you've printed it out or you have it up on your desktop, it follows right along. And part of the workbook is having kind of a Mad Lib note taker for you, meaning that you can just fill in the blanks. So a lot of the notes are already done. I think a lot of these calculations are kind of structured in there. You might have to just fill in the numbers. And that's one of the ways I kind of keep you involved, is that you can kind of follow along with what we're going to do. And make sure that you understand it. So let's not go too fast. Let's make sure that everybody understands each concept as we go through it. Slow me down. Say, hey, Mike, raise your hand. Whatever you need to do, use the chat box. If I don't catch it, Paula will say, Mike, we got something going on, and she'll clue it out to me. So with that in mind, we are going to talk about mining your business for hidden cash, and we're going to talk about optimizing cash conversion too, and I call that the fast money formula. So we're going to go over a couple of those things today. And I think at the end, I'll show you the tool and how kind of all this plays together. So here we go. Mining your business for hidden cash. First of all, I want to thank North Central Texas SBDC, because they have invited me in here for all month. I've spent the whole month of August with North Central Texas SBDC, and I get to see them in 2 weeks. I get to see them in 2 weeks when we all meet in Atlanta, and we go and enjoy each other's company, and it's going to be fun. So I can't wait to see everybody. Like I said, my name is Mike Milan. I also known as Cashflow Mike, and kind of got there in one of my companies. My largest company that I built was a hotel staffing company, and I opened 27 offices in 9 states in 3 years. And with that, I had almost 500 people working on a daily basis. If you can understand what we're doing, I put people in hotels to clean. They would do housekeeping. They would do janitorial. They would do kitchen type work, anywhere that we called the heart of the house, right? The thing that made the hotel work. But every 2 weeks, I had to make payroll. So I had to cut checks every single 2 weeks. And guess who didn't cut checks every 2 weeks? Marriott. They would cut checks like every 60 days or 90 days. So that was a lot of payroll that I had to cover. And that's where you kind of learn about a concept I'm going to talk about today a little bit later called the financial gap. So this is where the cash flow might comes into play, is once you've had to manage, that gap, you'll understand that the smaller the gap, the less money it takes to run your business. And that's the big takeaway I want you to leave today's hour and a half with. All right. As far as what we've covered, she said I had three books. I do. This one's free, right? So you can go right now to my website, cashflowmike.com, get the 7-minute conversation. I think that was the second week of this series. So number 2 in the series is these 6 calculations. So you not only have the video of walking through the calculations, you'll have the workbook or the actual book that goes with those calculations. And if you have any questions, or I make a comment or have something that you don't understand, just email me and we'll get you all squared away. All right, so here's what we're going to go over today. Mining your business for hidden cash is about comparing yourself to your own goals or to the industry average, right? So think about this. And I like to say it's what we should be, which is the average, the minimum average, the industry average, and what we could be. That's what our own goals are. So we're looking at our own performance and finding places where cash is leaking out of the business, right? And so I've divided up this technique into 6 calculations. And the 6 calculations, 3 of them are cash generating. How does money come into the business? And 3 of them are cash conversion. How long does it take to do these things, right? Money to move through it. So that's what we're going to be looking at, is not only doing these 6 calculations, understanding why I chose them, but then creating what's called a cash leak map. So you can visually see where money is leaking out of your business. So that's kind of our goal for the next few minutes, is go through these calculations and take a look at this cash leak map. And I'm going to tell you, you're going to just be blown away by how easy it is to find out where you need to focus your attention. So in this case, I'm actually meant to get past that. Sorry, I threw that out of order. That's from a different class. There you go. So in this case, we're going to be using year 5. So all along, I've used the same income statement and a balance sheet. It should be in your workbook. So it's year 5. I gave you 5 years worth, but we're looking at the most current year. So you can think about it like 2025. But I'm looking at the income statement and the balance sheet for year 5. Those are the numbers that I'll be using. So when you see numbers come up on the screen in the PowerPoint, you can cross-reference it to see where I got that number from. And I'll kind of go through it with you. So it starts off with these 6 calculations. And the first thing I have to do is kind of go gather something to compare it to. As I've told you in the past, I think when we went over the financial doctor, ratios don't mean anything unless you compare them to something else. They're just a number. You got to compare it to something else to understand how it fits in the world. Whether you're efficient or not efficient, can you improve, not improve? That you have to compare it to something else. So I'm going to start with the industry averages. And Paul, if I'm not mistaken, you guys have a tool in your office that your clients could go to get these industry averages. Is that right? Oh, I think you're on mute.
Again, muted, talking
Okay.
muted. We have some tools that we can actually get industry information, different types of information for our clients and share with them. Yeah.
Yeah, good. Yeah. So there's some of it on the internet. In the tool that I gave you, or that you guys got from me, the ClearPath to Cash app, the industry averages are built into that as well. So a couple different places they can get those. So the first place you got to start when you look at industry averages is, what is a NAICS code, a North American Industry Classification System, right? So most people, if they don't know what it is, maybe your accountant, whoever's done your taxes in the past, has kind of assigned one to you, and you'd find it on your tax return, right? So it's kind of at the top of the first page, what number they're using to report you under. If not, there's a tool. Census.gov has an NAICS tool that you can just put in keywords. I do construction. I'm a beauty salon. Whatever it is that you do out there, use those type of keywords and they'll point you in the direction of a code that you can use to compare yourself to other people kind of in that industry. Now, industry averages, it's collected data, right? So they could vary from even spot to spot. I mean, one service that has industry averages may not match another service. So it's kind of just remember it's a rule of thumb. It's not, an absolute. It's just kind of helps you understand how your business runs compared to others. So the first three that I look at, one is sales to assets ratio, the second one is gross profit margin, and the third one is operating expenses. Now, when you see these percentages or you see these numbers, they kind of mean something. They tell a story. Like gross profit margin and operating expenses, these are percentages of sales. So if sales is $100,000, if your sales are $100,000, well, that would mean 32,000 of it, roughly 32,200 would be in gross profit margin, and 29,100 would be in operating expenses. So that's kind of how you read these. These are always percentages of sales. This one's a little different. Now, most business owners that I know, they're not calculating up their sales to asset ratio. Instead, what they do is they go, how much do you think you're going to do in sales next month? And they go, I don't know. If I get a new truck, maybe 50,000. And they'll guess. And they'll guess just based on what their gut tells them what they've done in the past. Believe it or not, this is the ratio. This is the calculation where you can get closer, right? Instead of guessing, because this is the thing that says, how do I use my stuff? Assets is stuff like equipment, like trucks, like buildings. How do I use my stuff to generate sales? And I think what I've told you in the past is that the only reason to buy stuff or assets is to generate revenue and profit. Well, this tells you how good you are at using your things to generate sales. And if you see a number like 2.3, what that means is for every dollar that you invest in something, it generates $2.30 in sales, right? So that kind of helps you get a little bit closer. So if I bought a $100,000 truck after I got it outfitted with everything I needed to run in my business, I could assume that I'm going to generate $230,000 in sales, right? So that kind of helps you put your forecasting and your guesses, I guess, into a better frame of mind. So you're not just throwing out a number just based on your guess. You actually have a calculation to fall back on. All right, so these are the cash generating activity, right? We generate sales. This is how much we have after our cost of goods sold, what it takes to keep the sales moving. And then how much of that did we spend, right? So these are the three that we're going to look for cash generating activities. Cash conversion activities, that's about time. How long does it take to do things? So we're going to look at inventory, accounts receivable, and accounts payable. Now, if you're like going, I'm a service company, Mike, I don't have inventory. Great, your number is 0, right? So if you don't have inventory, we just use 0 in that place and we ignore inventory. That's basically what we're going to be doing. Now, if you notice, I'm using days as speed. When I was a state trooper way back in the day, I used to measure speed in miles per hour, but now I measure it in days, right? That's just I'm still measuring speed, but just in days. And believe it or not, we want things to move fast. When I was a trooper, you didn't want things to move fast. When I'm a business owner, I want it to move fast, right? Kind of the opposite. But when you measure it in days, you can get a visual representation of how long it takes to do things. Like this is saying that on average, it takes, or inventory sits on your competitors, the industry average, your competitor's inventory sits on their shelf for 66 days before somebody buys it, just on average, everything they got in the warehouse. And it takes about 44 days to collect on an invoice, right? So their customers are paying them in about 44 days. And this company, the industry average as a whole, pays their bills in about 34 days, right? So a little bit over a month. They get the bill, it's due, they pay it in about 34 days. Okay, so that's the 6 calculations. So let's use Sammy's data and see where we're at, right? We'll just do the calculations for Sammy's data and kind of see where he ends up. So is this good? Does this make sense to you, Paula? You're good? Cool. All right. Now, see what I did there? I actually converted these days because I've got to show you something right up front. When I do the calculations, I can't use days in the calculations. You have to convert it to what they call a turnover rate. You can see that down there? That 66 days equals 5.56x or turnover. And what they're saying here is that this is how many times in a year this happens or this occurs. Meaning that if inventory sits there for 66 days, that means I'm replacing it when it gets sold about 5-6 times a year, which makes sense. This is like every 2 months. So a little bit less than 6 times a year, I have to put it back on the shelf, right, to keep it moving. This is saying that I get paid about 8 times a year. This is saying I pay my bills about 11 times a year. You can kind of get that. So you have to look at it. I'm paying bills how many times? 11 times a year. That's about every 34 days, a little over a month. So less than 12. That's kind of how we read these turnover rates. To calculate this, all you do is take 365 and divide it by 66, and that comes up to 5.56. So we're converting the days just by saying, well, how many times does this happen in a year? 365 divided by that number equals the turnover rate. If I wanted to go the opposite way, I would take 365 divided by 5.6, and that would be, well, 66 days. Same thing with like 90 days, right? If you do the calculation there, it comes out to about 4.04, 4.06, one of those two. But it's still 4 times a year. And it should make sense because every 90 days, a quarter of the year, it happens. So 4 times a year, a quarter. All right. Cash generated activities. Let's start with sales to assets. Remember, I told you this is if I buy something, how many dollars come back to me in sales? How much sales does this new thing generate? Then I'll look at gross profit margin and operating expenses. So in sales to assets, the ratio is calculated this way: total sales divided by total assets, right? So on the income statements where sales come from, it's 8.4 million. And on the balance sheet where assets come from, it's 4.2 million. So if you're looking at the financial statements, the income statement has sales, the balance sheet has assets. Those where the numbers come from. You can kind of keep score that way. If we do the division, right? If we divide 8.4 million by 4.2, it's going to be around 2 something, right? We can kind of tell that's going to be around 2 times, right? 4 goes into 8 2 times. And the actual result is 1.98. So yay, I got a 1.98. But nobody knows what that means. Nobody knows what 1.98 means until I think about it the way I described it, which is how many dollars does it generate? This is saying for every dollar I put into stuff, buy a truck, buy a building, whatever, that building, that truck generates about $1.98 in sales. So a $100,000 truck generates about $198,000 in sales. Now, this is where I start to grade my clients. I'm saying, is this good, fair, or terrible, right? G, F, or T, and I just put it there because I want to focus on the things that we think we're terrible at, right? Well, how do you know if you're terrible unless you compare it to something else? Well, the industry average, based on what we just learned on the previous slide, was 2.3. So what do you think, Paula? Good, fair, or terrible? We're at 198, they're at 2.3.
Again, it's fair.
Yeah, I think it's right in there too, right? It's not terrible, but
Fair.
that means for every dollar they invest, they generate $2.30 in sales. We generate $1.98 in sales, right? So we're kind of fair. I wouldn't call it terrible. I wouldn't say it's good because we're below the industry average, but there's a little bit of room here, right? All right, let's kind of keep that going. Gross profit is the most important number on the income statement. I think I've said that in every single event that we've had, but gross profit is the only place you can get cash to spend on your expenses or put in your pocket, right? Gross profit. So we're going to divide that by sales. How much in sales do we actually get to use, right? We don't get to use all of it because some of it has to go to buy inventory or pay for the labor in a service company. So 2.5 divided by the sales number, 8.4, gives us a gross profit margin of 30.7%. So 30.7, right? Again, we don't know if that's good or bad. All we know is that's what it is. So if we compare it to the industry average, everyone else gets 32.2. Is this good, fair, or terrible? Good, fair, or terrible?
Still fair.
Yeah, it's about 1.5%. I mean, there's a little bit of improvement there, but we're kind of in the ballpark, right? We're not at like 10%. And everybody else is at 30. So I think, yeah, it's right in the ballpark. So not bad there as well. What about operating expenses? This is how you spend your money: rent, all those subscriptions we get for everything, some salaries, those type of things. All of your operating expenses, whatever it takes to keep your business running. That's what we're going to be comparing. How much of our sales do we actually spend to keep our business going, right? So 2.4 divided by the sales number again, 8.4 gives us a net profit of 28.7%, right? I'm sorry, not net profit, operating expense of 28 which means we spend about 28% of our sales just to keep the business running. Everyone else is 29. Who's better?
Still fair.
Still fair. But we're actually better than the industry average here, right? We're spending less.
Yeah. I see.
Yes. Right? Because everyone else spends 29% of whatever comes in. We're only spending 28, but it's pretty close. There's not a huge difference there. So we're actually doing decent. Probably fair still. I would agree with you. Okay, so these are the three cash generating activities. You're like, oh, yeah, what do I do with that? Well, nothing yet, right? We have to convert it to dollars because dollars is the language of business. If we want to know what's really happening, we have to talk in dollars. I don't talk to my clients in percent because I can't spend percent. Like, Paula, if you go to Walmart and buy a gallon of milk, how much is that in percent?
I don't know. They don't take my percent. I tried, but they don't.
See, it's 2%. You could have just said that. Oh, 2% milk, Mike. That's a milk joke. Come on.
My bad.
It's funny. All right, so that's what we got there. We got, we don't talk in percent. You have to convert it to dollars so you know the magnitude. Sometimes when people say, well, my sales are up 7%. What is that, $7 or is that $7 million? I don't know. What's 7%? That's why I like to convert it so we can see the magnitude of change. And is it worth even chasing down a problem? Is it, would you do a bunch of work for $4 difference? Probably not. So that's what we're going to. You have to convert it to the financial impact. How bad does it hurt because I'm not this way? All right. Then we've got inventory, AR, and AP. I've already put in the turnover rates. But when you convert or when you calculate inventory days, you notice everything gets multiplied by 365. That way we're converting the result to days. The reason I talk in days and not the turnover rate, it's easier to understand. People can wrap their mind around, oh, that was 30 days. That took 30 days to happen. They don't understand 12 times, or that happened 12 times. They understand the 30 days a little bit easier. So in this case, you take how much inventory you have on the shelf and you divide it by how much you've sold, right? That was inventory. Cost of goods sold is how much you actually sold of what was already there. What do you got left and what have you sold? That's kind of the ratio there. And you multiply by 365 and it tells you how long did it sit. And in this case, it's at 90 days. And look at there, 4 times a year. So that's what makes sense. That's why every 90 days, every quarter, 4 times a year is how that happens. Everyone else, it sits for 66 days. Who's better?
The industry is better.
Yeah, see that's where some people get confused. They're like, well, I got more inventory. I need all that inventory to make those sales. Not if you think of it this way, that remember I talked about, the elf on the shelf? Well, we call inventory wealth on the shelf, right? And you don't want it to sit there. You don't want it to be there. So the longer it sits, the more time your money is spent sitting on the shelf and not going to work for you or being put in your pocket. So if everyone else can make sales with only 66 days of inventory, then so can you, right? So I would say this is a huge opportunity. We have too much inventory. That's what that's saying. When this number is larger than this number, it means we have too much inventory. Now, if we look at it from the turnover side, they have to replace it 5 times a year. We only replace it 4 times a year. Remember I said we want money to move fast. We want things to move fast. So we're talking about 5 times a year is more than 4 times a year. So we want it to move faster. So that's good. All right. AR, this is a measurement of how much your customers love you. They love you so much they're willing to pay you and they pay you fast, right? That's what we're looking at. So we're going to take how much we're owed divided by how much that we sold in total, right? So this is how much we're owed still, and this is how much we've sold. Multiply that by 365, and it tells us how long does it take for customers to pay us. After we make the sale, and it's recorded on our reports, how long before the money hits our bank account, right? So in this case, it's 34 days, which is about 10, 11 times a year. Everyone else is 44 days. Who's better, Paula?
Actually, we are.
Yeah, we're actually better. We're actually good at making phone calls to collect money. We're actually doing pretty good here, right? So we're getting money in, and that's pretty fast. Here's the thing. On all 3 of these, inventory days, AR days, and AP days, my advice to clients all the time is let's keep those around the industry average, because you can be too aggressive on any of these and it hurts you. right? It's like a double-edged sword. You can have too much or too little, right? You got to find that right balance right in the middle. And that's why I say the industry average is a good place to be. Um, and it gives you something to do to fix a short-term cash flow problem. Meaning, well, first of all, let me explain this. You're like, on how is it going to hurt me if I'm collecting faster? Well, first of all, people know your competitors are around 44 days. What if I'm too aggressive in collecting money? Say I did this. You came and bought something from me and I handed you an invoice. And then 2 days later, I called you and said, hey, did that invoice make it back to your office? And then a week after that, I send you an email. Hey, don't forget about the invoice. Here's another copy. And then 2 weeks after that, I sent you another copy in the mail. So now you got it from email, you got it on a phone call, you got it, postal. And then about the month point, I go to your kid's school, pick up your kid and drop off your kid and an invoice, right? That would seem too aggressive, right? You'd be mad at me. You'd probably change vendors if I went and picked up your kid from school. So being too aggressive turns people off and it hurts your sales because your clients have a choice. They can actually say, hey, I actually like the guys that they give me an invoice and they don't really bother me till it's past due, right? They don't call me until 30 days. If you're too aggressive, people have a choice and they can go somewhere else. If you're not aggressive enough, well, that means you're waiting too long for money and you're making that gap bigger and it takes more money to run your company. You got to have more cash on hand. And we'll explain that in the next section with the fast money formula. So keeping it in the middle, if I get into a problem, I can start making some phone calls and pull some money in and then loosen back up, right? It gives you a lever to pull. All right, AP, this is how much I love my vendors. I love them so much, I'm willing to pay them money on time. All right, so in this case, we're going to take how much I owe divided by cost of goods sold. If you notice, I'm using cost of goods sold a lot here because it's optimized for the inventory. I want to have enough inventory to actually keep up with the sales volume. I don't want to have too little. I don't want to have too much, right? I want the right amount. So that's where all of this helps you manage cash by focusing on how you use cash to keep the sales going. So, and then we multiply it by 365 to convert it to days. And we're at 56. Everybody else is at 34. Who's better? Anybody? This is the hard one. All right. So you have to think about this one opposite, believe it or not. This is saying that I pay in 56 days and everyone else pays in 34 days. From a cash flow management perspective, this is good. You're keeping money in your company longer. From a relationship perspective with your vendor, the person helping you, it could actually hurt you, right? You could be missing out on discounts. You could get worse pricing because they're like, oh, he almost paid. It takes 2 months to get money out of this guy. So they could actually hurt your relationship where, heck, they could drop you, right? And say, we're not going to sell to you anymore because we don't like the way you pay. Or they can move you to COD, right? So you could actually put yourself in a worse position by paying so late that it hurts your relationship. You can also pay too fast and you're giving away too much money up front and you're putting yourself in a cash flow problem as well. So that's why 34 is where we should be at, because that's what the market expects. If you're there, you just kind of blend in. And if you get into a cash flow problem, you can sit on an invoice an extra week or two and nobody really thinks anything of it. But this, if we look at the turnover, I pay my bills about 6.5 times a year. Everyone else pays their bills about 11 times a year. So that's kind of how we read that. So this is considered good, even though the number's better. So all the phone calls we love to make to collect money, we don't answer them. We're going to answer the phone on this side to actually pay other people's bills. So we're a little slow on paying. All right, so that's the 6 calculations. But what we learned right up front was whether or not, where we're at in the industry. We can tell right away on, where we got improvement or where we got opportunity or where we're really falling behind. So those are the 6 calculations. The second step is to convert these to dollars so you know which one's important or not. You can't really see it from these calculations, but you'll be able to see it in the next step. So let's do the cash generating activities first, right? Remember we had sales and up front we had 1.98 and everybody else had 2.3. We said, hey, this is fair. We're kind of right in the market. Well, if we convert it to the impact, what we're saying when we convert it is we're answering this question. If I was average, I would sell this much with the amount of stuff that I have, right? So that's the question. If I was average, I would sell this much, generate this much revenue because I have this much in assets. That's what it's saying. So I have $4 million in assets. If I was average, I wouldn't make $1.98 for every dollar I put in. I would make $2.30. So we're going to multiply it. This is saying that I should be selling 9.8 million, right? That's what it tells you. People don't use these to actually come up with their forecast, but I'm like, hey, if I was average, that should be my next jump is to get to 9.8 million. I'm not selling that. I'm only selling 8.4 million. So that means there's an opportunity of 1.3. I'm worse than my competitors. They're actually generating about $1 million more with the same amount of equipment. Some people go, oh, that's terrible. I don't. I say that's an opportunity because remember, the only reason to buy stuff is to generate revenue and profit. This is saying we don't have to buy stuff. We have enough stuff to just sell more. All we got to do is go sell more, right? So that's what this is saying. If we're a client, if you're working with us and this is your problem, there's other low-hanging fruit. Sometimes sales is the hardest one to fix. So what we're going to do is we're going to set this aside, but realize that I don't have to spend more money to go sell more. I can just do it with what I have. So there's $1.3 million right there. Now, the second one, gross profit, how much is left over after we make the sale? We were at 30%. Everybody else is at 32, is 1.5%. We said, we're fair there. 1.5%, it's not that big a deal. Well, if we were average, we would also make 32%, not 30, right? It's a 1.5% move. So if we take 8 million and divide it by what everybody else gets, that means their pricing is right there. We would be market price, the same as everybody else. It'd be 32%. We should have gross profit of 2.7 million. Now, if you go look at the income statement, that's not what we have. We actually have 2.6, 2.5. So the difference is $126,000. There's $126,000 here that we can get and put in our pocket with just one move. We just change pricing or we negotiate with our vendors, right? All we got to do is manipulate cost of goods sold. Now, if it's 1.5%, I'm calling on my vendors. I'm not going, hey, man, hard times over here at Cash on Mike. I'm gonna need a little help on my pricing. Can you guys give me about a 15%, haircut on pricing? Can you give me a discount? And they're gonna go, no, we're not giving you 15% discount, but we'll give you 3. Okay, I only need a 1.5% move to make $100,000, and because I've already covered my cost, meaning I might break even or higher. All of that money goes into my pocket. I don't need it to pay expenses. That's my money now. That's my money to run the business and put in my pocket. So 1.5% is worth $126,000. If you give me 3%, that's going to be closer to $300,000 or $250,000. You got to think about it that way. So that's a big opportunity there. The next one is how do I spend money, right? How am I spending it? I spend about 28% of sales to run my company. Everybody else spends 29%. So remember, I'm better. I'm not spending as much to run the company. So if I was average, I would actually spend a little bit more. I would spend 29%. And that means my operating expenses should equal around 2.5 million. And they don't. They equal 2.4, 2.428. So I actually have $31,000 more than my competitors here, right? So that's where we just pat you on the back and say, hey, keep it up. You don't have to increase your expenses. I mean, you got a little room if you need to, but you don't have to, right? This isn't you should go spend more. This is, hey, you're doing great. Keep it up. Because the goal is always to be better than industry average, right? The goal is to be better. You remember industry average is a C in business. They're getting a C. That's an average, right? You want to try to be an A player or a B player. Right, so we would actually try to move this even up a little farther. Okay, next 3. We found in the first 3, we had a sales problem, we had a gross profit problem, we were good in operating expenses. And I always look at these things together as one whole picture rather than in silos, because you can see sometimes we're up, sometimes we're down. So I look at them all together to find out where the real problems are. All right, when we look at inventory. What I like about this is that some people go, well, I don't know how much inventory I should have. This is the calculation that will tell you how much you should have, right? It's going to give you a dollar amount. So when you look at your balance sheet, you're going to go, oh, I'm over or I'm under. This is where that number comes from. So we have 4 times our inventory turns over 4 times at 90 days. Theirs turns over 5 times at 66 days. Let's convert it. This is going to tell you exactly how much inventory is too much inventory. So in this case, cost of goods sold is 5.8. So we need to spend that to keep up with our sales. But if we moved it faster, if it went off the shelves just a little bit faster, we could actually only have about $1 million in inventory. This is what it's telling you. Based on how much you sell, if it moved a little faster, which means you don't have as much, so it doesn't have to sit as long, you should have $1 million. So if you want to move it faster, reduce your inventory to $1 million. So you compare it to what you actually have, actual inventory, and it's 1.4. So we have too much inventory. And now how much is too much? $383,000 too much. That's a huge impact, right? That means that you have $383,000 sitting on the shelf that your competitors do not. And if you reduce it, run the volume down, how much is sitting there? Well, you'll put that money in your pocket. Yeah, because A, you'll get the money from the sale, and B, you're not taking money out to replace it. All we're going to do is run the inventory levels down. Some people don't know what to run it down to. This is your goal. I want that balance on the balance sheet, right? The inventory number, the account value to be 1 million and not 1.4. So you'll know when you'll have about the right amount of inventory because it's going to show up on your balance sheet. Opportunity, another opportunity there. Okay. Any questions so far? I'm kind of going through these maybe a little fast, but nobody's stopping me. So, okay. Let's talk about how we're paying. This is going to tell us how much we should be owed, right? So the number that comes out at the end said you should be owed this much if you want to be average. So ours, we get paid almost 11 times a year. Everybody else gets paid 8 times a year. So I'm getting paid faster. I'm getting paid 11 times. They're only getting paid 8 times. If I convert it and I was average on my sales volume, I would divide it by 8.3, like everybody else gets paid. And on the balance sheet, I would see $1 million. I should be owed $1 million by my customers to be average. But I'm not owed that. I'm only owed 778. So I'm owed less, which is actually good, right? You'd want to be owed less than everybody else, which means you're better than your competitors by about $239,000. You have more money than they do because it's coming in faster. So I would pat you on the back, say, hey, good job. Let's not change a thing. It's working. Then the next time is accounts payable, or the next one's accounts payable. I pay about 6 times a year. They pay about 11 times a year. How much should I owe, right? Yeah. Alexa's trying to answer a question. So this is going to tell us about how much we should owe, right? About how much we should owe. So in this case, current cost of goods sold, our current sales level is about $6 million. If we were average, we would be paying our bills 11 times a year, and we should owe $542,000. That's how much should be on our balance sheet right now in the accounts payable line, $500,000. When we look at it, it's not, it's $893. So we owe more. Here's where people get confused. Just because you owe more doesn't mean it's bad. That just means that you haven't paid it yet. Everyone else has already paid it. This is what this is saying. So you have or should have $300,000 more in this category than your clients. You're like, what? That's a negative number, Mike. I know, because it's a payable. It's money going out. That means we have more money than everybody else, right? We owe it. They've just already paid it. They owed it too, but they've already paid it. That's how you read this. So it's nice work. We did a good job. Now, if we were sitting here consulting, you go, yeah, that's a lot of numbers. I don't know how to do it. That's why I wouldn't show you the numbers, like this. I just wouldn't, because I want you to focus on bite-sized consumable chunks of information that drive action, that get you to go, oh, I know exactly what to do to fix this. So we're going to create the cash leak map out of these numbers. I'm just kind of walking you through how I get to the cash leak map. But in the tool that the SBDC has, my ClearPath to Cash, this map gets generated automatically as soon as they type in about 8 numbers, right? So here's how it's set up. Here's how this chart is set up. You have a goal line. Remember I said there's a should and a could. We're only doing one version. We're going to do the should. You should be at your goal. This is the industry average. Every time I'm better than my competitors or better than the industry average, the information will be above the goal line. Every time I'm worse than the industry average, the numbers will show up below the goal line, right down here. That's why I call it mining your business for hidden cash. We're going to look for the opportunities that are below the line, right? So here are the 6 calculations: sales, gross profit, operating expense, inventory, accounts receivable, accounts payable. In sales, we were about 1.4 million. I'm rounding up using the KISS method. So rounding about 1.4 million opportunity. But we said this was kind of okay for now, because this means that I don't have to go buy more equipment to generate more sales. I know I should be able to sell about $1 million more before I think about buying another piece of equipment. Then gross profit, we had an opportunity. 1.5% was worth about $127,000, right? So there's an opportunity. Operating expense, we were better, right? We actually had more money in operating expense. Inventory, we had too much inventory. How much? $383,000. Accounts receivable, we were better. We were getting paid faster than our competitors, and we're paying a little slower. So we had more money. You can see why I do the big cash leak map, because it shows the whole picture. Not only how money comes through vertically, sales to profit, but how long it takes for this stuff to happen. So it's like looking at it from 2 different directions. And what we find out, if I ignore sales, because we're going to work on that later, here's 2 opportunities, 127 and 383. So that's around $500,000. What I would say is, hey, in 2 moves, we can put $500,000 in your pocket. Would you be okay with that? Right? And the 2 moves would be, we need to improve gross profit, right? Which means we either need to change our pricing or look at the way we price our goods or services or bid our projects, or we can negotiate with vendors and maybe try to bring down our own pricing for cost of goods sold, or change the labor rates if we can do that. But there's ways. This is about cost of goods sold. This says there's a cost of goods sold problem, right? Remember, there's 2 different expenses that we have. One is a variable expense, that's your cost of goods sold. The other is a fixed expense, that's your operating expense. And we don't have an operating expense problem, so I'm going to leave that alone. The next thing that we do is we run the inventory down. And what I do is I go through all the SKUs or items that people are selling, and we use a basic formula to determine how much they should have of each one. I know I have to find $383,000 worth to run down. Well, let me show you the basic formula. The basic formula is this. I'm going to use my finger pencil. If you want to know how much to have of any one product, right? Any one product. And I'll use cases of Budweiser, right? If you're running a restaurant or a bar, how many cases of Budweiser should I have when I go to order, right? So you're going to take the average, whatever that is, the VG. I'll try to make it. There you go. Average number sold per month, right? So if I'm just looking at Budweiser, I might have 100 different items, but if I look at one, average number per month that I sold, and I divide it by the number of times I can get it delivered that month. Number of deliveries. All right, so, and yeah, this thing is not working great today. Number of deliveries. So that's what we're talking about. So if you want to know how much you should have, we're just talking about cases of Budweiser. And let's say that I sell 200 cases in a month, and I can get it once a week, right? On Mondays, the guy comes in to do my order. So once a week, which means I can get it 4 times a month on average. What's the result there? How much should I have at the beginning of the week, Paula? 50? So at the beginning of every week, I should have 50 cases of Budweiser in my walk-in cooler. So if I go in to order, right, he comes in and says, how many do you want? Some business owners will go, I don't know, bring me 10 of this, 15 of this, and they'll just make it up. What they need to do is go into the cooler and say, oh, I have 60 of these already. How much should they order? The answer is 0, because this is the line. Anytime I'm over, I don't order. Anytime I'm under, I only order back to 50. So if I have 20 cases, I'm going to order 30. And when I do that, I really never have too much and I really never run out. That's because I'm staying right around what my sales level is. So you do this on every product, and that's how you understand which ones to run down, right? And maybe to run it down, if you need cash a little quicker, this is where the large retailers like Target and Costco, they'll have these markdown strategies. After stuff has been on the shelf for a specific amount of time, think 60, maybe 90 days, you'll see it move through a progression of maybe a 10% discount, then maybe a 25% discount, and then maybe move to a clearance rack where it could be 50% or better off. So, but they have a strategy to always keep the oldest stuff moving out as fast as possible. You can do the same thing in the smallest of businesses. This calculation will get you to about how much you need, and then you just have a way to move it forward with markdown strategy. So we just found 500K. What I do with my clients is say, would you like my help to help you put that in your pocket? So that's kind of what we're doing. All right. Questions, concerns. That is mining your business for hidden cash. Erase all the ink on the slide. And what I want to do is, where we're at on time. Okay, good. I want to show you this thing that we just talked about inside the app. All right, so let me share. And where is Google? In the app, the Clear Path to Cash, there is a hidden cash calculation, right? So we've got, you put in your financial data. If I put in financial data, I'm on hidden cash. I'm just going to enter in, what my goals are. Then I'm going to enter in 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 numbers, and it does all the calculations for you. When we look at the result, right? When we look at the result, let me change clients here. When I look at the result, what I'm going to do is see what it is. See, this chart should look familiar. 0 is the goal line. Everything that's red below the line, those are opportunities. Everything that's green above the line, well, that's where you're doing good. Pat yourself on the back. Now, this is saying in total, this company, we found $2.9 million. Now, this is against you versus you. That's the could, the owner's goals. Right below that, I have you versus the industry, right? So to make this come to life, this is something I can't do on the PowerPoint slide or can't do in Excel, but to make it come to life and to get your attention, I'm like going, hey, listen, remember I said don't worry about sales right now. We have 2 other pieces of low-hanging fruit that we can go after. So I turn it off and watch what happens to this, because this is a cumulative number. I turn it off and boom, now it readjusts. Just in these categories, there's $1.2 million in hidden cash. But we're doing good. We're doing good in operating expense. We're doing good in collecting money, and we're doing good at paying our bills. So let's turn those off, right? Because you're doing good. I just don't want you to focus on that. I want you to focus on these 2 big red blocks, because this is where your biggest problems are. And believe it or not, there's $1.5 million in just these 2 categories, right? So we know we have a gross profit problem, and we know we have an inventory problem. Here's some strategies to go do it. And what I do in the app is I write down our plan, right? I just take notes, write down a plan, have them go do things, and report back to me in the next meeting of how it's going. So that's using the app to be able to do this mining your business for hidden cash calculation that we just went through. And it's as easy as just typing in the numbers and reading the results. What do you think, Paula? Slick, huh?
I have always thought it was slick. I can't wait to actually delve deeper into that whole app, because I think it's going to help uh, so many people, but mainly it's going to keep me from having to math a lot, I believe. So that's better for everyone concerned.
Yeah, super cool. Okay, I'm gonna teach you a different way. This is called the fast money formula. it will help you determine the difference between how much money you have and how much money you need. A lot of people can calculate up how much they have or have access to. Nobody really tells the business owner how much they need, right? So this is kind of the calculation. Now, you should also know this is the same calculation I teach bankers on how to calculate how much of a line of credit you need to keep your business running. All right. So it kind of can be worked for that as well. Well, let's kind of go through it. This is going to be about identifying the levers that it takes that you can pull to reduce the amount of money it takes to run your business. If you feel like it's clunky, if you ever felt like, oh, I'm always waiting for money to come in before I can do something or pay a bill, that's because your financial gap has gotten too large. Now, let me show you how to calculate the financial gap because I keep talking about it because it's that important, right? In the very beginning, I think issue 1, I showed you a picture of the financial gap saying this was the picture that changed my life. It changed the way I thought about how money works. It changed the way of me thinking profit was important to cash is important, right? That's kind of the shift in focus I made. So it kind of starts off with this stuff called working capital. And people go, oh, what's working capital? You know, it's not just the money you have, it's the way you use your money as well. So the calculation is this: current assets minus current liabilities. And when that number, this means the stuff that I have, like your checking account, and I'm just using examples, right? Checking account is a current asset, credit card is a current liability. This is saying, do I have enough money in my checking account to pay for my credit card, right? That's kind of what it's saying that way. If it's a positive number, I call it the cushion, right? You got a little bit of cushion there. If it's a negative number, we got some financial difficulties, right? Meaning that we don't have enough money to keep up with our own debt. Right. So you always kind of want this to be a positive number. Now, in Sammy's company, he has 2.4 million in assets. That means his inventory, his checking accounts, those type of things in assets, and AR. And he owes about 1.8 million, right? His bills for his inventory and those type of things. And that means he has $630,000 working capital, right? And people will tell you that, oh, you got 630,000. Is it good, bad? What do you think? That's why I don't like this calculation though, is because it seems like a big number, but we don't know if it's enough. It doesn't tell us how much we need, right? I could have 630,000, but need a lot more. That's why it doesn't feel like I have that much. Okay. So how much do you need? First of all, let's look at I'm going to show you 2 different ways. One is if you have inventory. The other is if you're a service company and don't have inventory, right? So you'll see it both ways in this calculation. First of all, you've probably seen these before, you know, inventory, how long it sits on the shelf, how long it takes to get paid, how long it takes me to pay my bills. Those are the 3 primary levers of cash conversion. That's why I call them cash conversion activities on mining your business for hidden cash. The calculation is super simple. Remember, we talked about these in days: 90 days of inventory, 34 days of AR, and 56 days of AP from the previous lesson. So all we do is just add and subtract. We're going to inventory plus AR minus AP equals the financial gap. The financial gap is theoretically the amount of time where you don't have enough money to run your business, right? So you need to have working capital or a line of credit to cover that amount of time. So in the hotel staffing company, remember I was making payments to my payroll payments to my employees every 2 weeks, but I'm waiting 90 days to get money. So there's a difference. I have to have so much money on hand to keep making payroll before I get paid in the future, right? So if you look at it from an inventory company, here's kind of what happens. I call a vendor and make an order, and they show up with my order. Not only do I have inventory on the shelf now from the order I just made, but they gave me an invoice. So I take their invoice and I throw it on the desk, right? That's what happens in real life. I put the inventory on the shelf, put the invoice on the desk. Then the inventory sits on the shelf for a certain number of days until somebody says, hey, I want it, I'll buy it. And somebody buys it and I give them something off the shelf and their own invoice. And they take my invoice and go sit it on their desk. So now I moved some inventory and I got 2 invoices, right? One on my desk, one on their desk. I pay mine to the vendor. Then I wait sometimes to get paid from the person that bought it from me. That's the whole visual of what's happening, right? I've already paid mine and I'm still waiting for money to come in. Well, this is the calculation that makes it so. Inventory sits on the shelf, then finally somebody buys it, and then I wait for them to pay it. But at the same time, I'm paying my bills. That's the whole calculation. Like I said, excuse me, I don't look at things in silos. You have to look at these things together because they happen all simultaneously on top of each other. And to make it come to life, let me show you on a calendar how this looks. So let's just say my inventory sat there for 15 days before somebody raised their hand and said, I want it, right? This is just a calendar. That's 15 days, right? So it sat there. I put it on the shelf. Somebody finally said they want to buy it. So when they bought it, they paid their invoice that I gave them in 27 days. So that's how long I'm waiting for money to come in. Remember, at the same time, I had my own invoice for the inventory. So I'm going to subtract out the amount of time that it took me to pay my bills. Let's just say I paid them in 30 days. Well, you see this? You see the difference in colors there? I overlaid it on top because they happen at the same time. And there it is. Does it completely cover? It doesn't, right? We still have this part down at the bottom, which is 12 days. That's the financial gap. You need to have enough working capital or room on your line of credit to cover that many days worth of expenses. Now, because we're talking inventory, you're still going to make sales during those days. So you need enough inventory. So you have to pay for the inventory to cover that amount of days. Make sense?
Mhm.
All right. So let's do that. In our company, we had 30 days more inventory than everybody else. We paid faster and we collected slower. Here's how the numbers shake out in Sammy's company. 90 days of inventory plus 34 days of accounts receivable. What's that? 124. Then
Yes.
we're gonna subtract out how long it takes us to pay our bills. 56
Mhm.
gives us financial gap days of 68. 68 days is how much I have to have available to cover. If your business doesn't run smooth, it's because you don't have enough money to cover that time. That's how this works. So let me explain how much you need, right? Because we said how much we have. You remember how much we had, Paula?
No.
All right, it's like 3 slides ago.
It's 30,000.
630,000, right?
Okay.
That's how much you have. Suresh got it. 630 says
Thank you.
how much that you have. Now we're going to tell you how much you need. So this is going to start off with I have to buy inventory to keep up with sales because if I don't have the inventory, I won't be able to sell it. So this is how much I sell in a year. And because I know that's how much I sell in a year, I divide it by 365. This will tell me how much that I spend on average just to keep up with my sales. So I'm spending about $16,000 a day. Now you don't cut a check for $16,000 a day, you cut them in bigger chunks. But on average, that's how it works out because we're comparing days to days. That's why we have to make this transition. It's so many days of this. So I have to say, how much do I spend per day to make the calculation? So I need $16,000 a day times the 68 days where I'm waiting for money. I've already paid my bills. I'm waiting for money to come in. So how much do I need? Suresh, you know this one? 16,000 times 68. Yep, $1 million. $1 million. Now does 630 sound good or bad? Or, I have 630, but I need $1 million, right?
That doesn't sound that good.
Well, that's why it feels clunky, right? Because we don't have enough money to cover our daily needs. So that's where people start to do crazy things, borrowing and holding off on bills and doing all this stuff because the money's not coming in the way it should. So there's a cash shortage here of $460,000. Now he's got options. He's got 3 options. One, if he has $460,000 in the bank, just put it in there. That would be your capital infusion. Too many people guess at how much their company needs. Well, we need to put money in, and they go, I don't know, 100,000. They just guess. This is telling you that if I put $100,000 in, I'm still not going to solve the problem.
Mhm.
It's not enough. This is also going to tell you that if I don't have a line of credit, maybe I should get a line of credit and I should ask for 500,000 because they give it in round numbers like that, the lines of credit. So 500,000 would be kind of the number I'd ask for because it solves the problem. If I have a line of credit and the line of credit isn't for $500,000, then I need to change my balance, right? Change my limit if I can, expand it, extend it. But that's what it's telling you. Now, I said there were three. So get a line of credit, put your own money in, or we can actually, before we go beg owners for money or before we go to the bank and ask for a loan, let's see if we can adjust the way we run our business first, right? Let's see if there's any little things we can do to make it better, right? And we got three levers to pull. One is inventory. We could have less inventory. One is accounts receivable. We could collect faster, which would be hard because we're already collecting faster than the industry. We could pay slower, which would also be hard because we're already paying slower than the industry. So the real lever we got to pull in this sample is what? Just inventory, right?
Mm-hmm.
Because we have 30 days more inventory. What if we just reduce it from 90 to 60? We're already collecting too fast. We're already paying too slow. Let's not get in trouble. Just keep those where they're at. So I'm going to reduce inventory to 60 days. Remember I told you the smaller the gap, the less money it takes to run your business, right? It's just like if you think about the financial gap as a gap in the sidewalk, is it harder to jump over a small gap or a large gap, right? The larger the gap, the harder it is to run your business. So this makes it 94. I'm keeping everything the same, right? 34 and 56 are the same. All I did was change inventory. I ran it down, which puts more cash in their pocket because we have the sales and we didn't remove the cash to replace it, right? So it gives us more cash. But that gives me also 38 gap days, right? If I do the same calculation, instead of 68 days, I only need to cover 38 days. So my cash need goes to 609,000. I only need 609 now, not a million. All I did was run it down, and that put $300,000, $400,000 back into my pocket. So I have 30, 630. I need 609, so I don't have a shortage. I don't have to go to the bank. I don't have to put money in myself. All I got to do is run the inventory down, and I solve the whole problem. So that's an inventory-based company. Questions on that? Okay. This is what it looks like for a service company. A little different because they don't have inventory, but they do have what I call an inventory of hours, right? Because every week these hours build up and they have to make a payroll payment, right? So it's still an inventory. It's just a little different. So we're going to ignore inventory like shirts on the shelf, and we're just going to have an inventory of payroll that pops up. So inventory is 0, so nothing happens over here. Let's say that I'm selling on credit like I did the hotel staffing company and they're paying me in 25 days, right? So I'm waiting this long to get paid. But all the meantime, I'm racking up payroll hours. So now what you're going to do different for a service company is you're going to take the accounts receivable days and divide it by the payroll days. If I'm paying every 2 weeks, I'm paying every 14 days. This will tell you how many times you have to make payroll before you get paid, right? So in this case, it's 1.78. Now, in reality, I don't pay in 1.78 payrolls. I pay 2. So I'd roll it up. My problem, the reason why you're seeing 1.78 is because I teach this to CPAs, and if I put 2 there, they're going to go, that's not 2, that's 1.78. So I put the real number here, but in reality, I'm planning for 2, right? Because here's payroll 1, 14 days, and then I have to cover payroll 2. So I should have enough money for 2 payrolls, is what I'm saying. That's the difference between an inventory and a service-based company. So how much do you need? This is where it comes out a little bit different because you have to take not the cost of goods sold the way that you did. You have to look at it from a different perspective. It's the average fully loaded payroll expense, which is all the money you give the employees plus the matching taxes and any benefits that you pay. Fully loaded, all the money that goes out during payroll. Let's say it's 3.26, and just keeping with accuracy, 326 times 1.78, this company needs $580,000 if they were a service company. How much do they have? Anybody? 630 still, right? Working capital doesn't change for a service company. It's still current assets minus current liabilities, 630. They need 580. Do they have a problem?
No.
No, they shouldn't have a problem. They should be able to cover
No.
their payroll. Should be able to cover the payroll. All right, you did it. So let me show you now how this works on the app. It's 12:34. I just saw it. My wife and I have this little thing where if you see it, you text the other person, and it's like, I'm thinking of you. 1, 2, 3, 4. We're okay. Too much sharing, Mike. Get back to the math. Okay, we're going to do the same thing. Still demo company, but I'm going to do the fast money formula. That's what we just did.
Okay.
Here's what I love about the app in this case, right? First of all, I can select between service company and, I just select service company or not if I want to. But let's go to the fast money test. See here, inventory plus AR, that's the money coming in. We're waiting for money to come in. Minus AP equals the financial gap. That's how this is laid out. This is an inventory company. If I go service-based company, it changes the payroll optimized. That's waiting for money to come in. And how many payrolls do I have to make before, I get paid? Make sense?
Mm-hmm.
That's all you do is flip a switch. What would I look like if I was a service company? Okay. Now this is where you'll see this inventory. This is the legend for up here. Down below is the most important part. How much money I have? 630. How much do I need? About $1 million, right? Just right from our example. And it tells me how much I'm short. I'm short $300,000. Like, okay, well, what do I do? Well, before we go to the bank, before we, go ask the owners for money, we have levers to pull. So for levers, I built sliders into the app, right? It's like you're pulling a lever. And what I'm doing is I want to reduce this number. I want to see what is the combination of moves I can make to make that number positive, right? The cash flow status. Right now it says we're short $300,000. So let's reduce inventory. And by reduce, it's at 92 days. I'm going to just slide it backwards. You see what's happening to the number? And I'm waiting for it to hit positive in blue. There it is. See how it goes from red to blue? It says, okay, I need to have this much money. I right there, 4,000. That's about the lowest I can get it. So I need to have 63 days worth of inventory. And then your client's going to go, how much is 63 days? Oh, here it is on the balance sheet. When you see the balance sheet and your inventory is over $1 million, I want you to run it down because you're going to work into a cash flow problem the higher that number gets. So now I've got a client or my own business where I'm like going, $1 million worth of inventory is where I want to keep it. If I get over than that, I'm going to work myself into a problem. So now I've got a way to talk about what I should be doing. Same thing is, what if my clients start paying me slower? What happens? Oh, that runs me into a problem. What if they pay me faster? Well, then I make more money faster. What if I pay slower, right? What if I pay faster? You can actually talk through scenarios like, hey, listen, I know you like to pay your bills fast, but here's what's going to happen. You need to sit on it for an extra week or pay them, just set your timer for 14 days or 24 days or whatever this number comes out to be. All right. And that way you kind of help avoid the cash flow problems to begin with. Remember, my mission is to eliminate cash flow as a reason that businesses fail. And I think they fail because they don't pay attention to these type of numbers, how the money moves in and out. Questions, comments, concerns, moans, groans, gripes, complaints, otherwise.
See, now that would keep me from having to do math.
That's exactly
Sliders
right.
and stuff. That makes it all worthwhile.
That's exactly right. That's why we did. Even in Excel, I mean, this doesn't break like Excel does, right? Where you can get the, mess up your calculations and you do a what if scenario and it changes everything on that you didn't want changed.
Yeah, well, I had a question.
Sure.
Yeah. So, in accounts payable, for example, sometimes it could happen that your recommendation could be to negotiate a new contract where the terms are relaxed, for example, instead of paying 30, pay in 45 and still not damage the relationship, right? Is that something that is
Yeah.
possible?
Yeah, that's it. And this would kind of help you determine what you should be negotiating to, right? So let's just go back to here and I'll reset these values and just say, hey, listen, well, this guy's already at 60 days, but let's just say it was something different. Maybe we didn't have too much inventory, but we were paying faster, right? Let's say I was paying in 30 days as it is, and maybe they were paying me a little slower. Maybe they're paying 46. Okay, so one of the things you could do here, instead of just negotiating, any old term, making it up, you can say, hey, listen, I know I got net 30 right now, but is it possible, and however you want to negotiate it, you just slide this to pay a little later? And I'd be looking for that right there. I want to pay in 51 days. Can we, now you got a number to work with. You see what I'm saying there?
Yeah, that makes sense.
Instead of guessing, you say, listen, anyway, I can get 45 days. Maybe you can say, instead of 30, I need net 45. And, maybe you can collect a little faster, right? There's ways that you can kind of just adjust it, because what you'll be able to do with your client here is make minute little maneuvers, right? Hey, you collect 1 day faster, that changes by X number of hundred or thousands of dollars, right? Or you reduce inventory by 2 days, right? You can start to see that, hey, that's worth almost $30,000. So it helps them visualize what a small change can do and which lever to pull.
Yeah, that makes sense. Now, if you had a client that came in, at what point in time would you look at these statements? For example, they come in April and they have these problems and they need help. Would you look at the previous year, or would you look at it from until March to March, or how do you?
Yeah, so I generally have a 12-month plan, but I've followed it probably 0 times. It's really weird. That's the whole reason why my clients have me write this book.
Mm,
Don't tell me what to do, because this is about problem identification. It's about uh, there's a whole technique that I teach called clearing the noise, and it's about listening to what their story is. What are they telling you? And for an example, and this is somewhat off topic, but I think it's beneficial. Let me see if I can't pop it open for you real quick. So I gotta find. So I want to show you the visual from. Let's see, where's it at here? I gotta maneuver this just a little bit so you can see it better. All right. So what I built in this book was called the elevation sequence. And of course, I didn't share it. I popped it up, but I didn't share it. PowerPoint. All right. Can you guys see this?
Mhm.
So the elevation sequence is a series of questioning techniques, and it was developed from when I was a state trooper. It's a combination when I was a state trooper and from watching 13 seasons of Hoarders. I know that sounds funny, and it's not because of the disorder, right? I want to make that clear. It's not about the disorder. It's about the conversation between the psychologist and the person with the disorder, because it's taking what I think when I consult with business owners, sometimes there's a mess that's built up and they don't know how it got there, right? And it's just kind of there. But the psychologist, the way they ask the questions, not only gets people to take action, it's better than compliance. It's commitment, right? Meaning they're doing it because they think it's the right thing to do and they know it's the right thing to do, not just because they were told to do it, right? So that's why I wrote the book and called it "Don't Tell Me What to Do." And tell means TELL. It's like my dumb book, Don't Understand My Business. Tell means terminate every long lecture, because I've seen too many clients and advisors now that what they want to do is prepare a presentation ahead of time before the guy even, the client or the business owner walks in, and then lecture to them what should be happening, what should they be doing. And I'm saying let's change the thinking to a working session where we're working together. And what I'm doing is asking you a series of questions to identify the right problem, and we'll work on that. It's part of clearing the noise. Hey, what's keeping you up at night? What are you worried about? Because I might think we're going to do forecasting because it's April and we're going to do forecasting, but they might be saying, hey, I don't know how I'm going to make payroll in 2 weeks. They don't want to talk about forecasting. They want to talk about what can I do to make sure that I don't have this stress on my shoulders. And sometimes they're afraid to tell it because we've worked them into a position where I'm lecturing to them when they come in. Here's my presentation. Here's my report. Here's my big binder and my slide deck. And I mean, well, whatever you're going to do. I've removed all of that, and I'm doing almost everything on the app now. There's a few things I do in spreadsheets, but it's working with them together. So my conversation will go from, hey, what's going on in your world? What's happening with you? I'll just start the conversation like that, every conversation. And when I do that, they start to tell you, oh man, this happened at work there. This I got an employee problem. I got this, that, or the other. What I'm listening for are some visual clues that I can put them into a bucket, right? Or verbal clues. So these are the questioning techniques. This is what I'm trying to do. This was sideways because this was a handout that I presented. But this is going to show you what bucket. I'm trying to put you in a bucket. Do you have an education problem? Is it a profit? Is it cash flow? Is it debt? Is it about operations? Is it about the future? Normally, all the problems that I see, I can put into one of these buckets. And then I use the clear path to cash technique that we've gone over these last 4 weeks. And right out of this book, one of these techniques that I use to solve the problem, or at least identify what it is and then solve it. So if somebody says to me, let me pop that open so it's a little bit bigger. If somebody says to me, man, my accountant keeps giving me all these financial statements, I don't know what to do with them. That's an education problem, right? I don't know how to use these things. They're asking you to say, hey, can you explain how to use these things a little better? Well, when that happens, I've got these two things. And I always start with the home run financial system. Remember the 6 calculations? I go, hey, listen, financial analysis can get so broad, so deep, so wide. It takes some people years to figure it out. Let me give you 6 things, just 1 or 2 calculations for each one of these statements to start with. It gives us a base, and then we can build on it, right? So I teach them the home run financial system and show them how it works using the app. Does that make sense?
Mhm.
When they tell me they have a cash flow problem, I'm going to use one of these 2 that we had today, right? The fast money formula or mining your business for hidden cash. And it's going to be determined on what they say. Meaning mining your business for hidden cash, if they say stuff like, oh, I just never feel like I have enough money, or yeah, I don't know where it's at, right? Or the fast money formula, they might say, my accountant says I'm making all this money, I never have any. They'll say something like that. Well, I don't have any. Why is my bank account always empty? Well, if you're making money, that means you're making sales, you're getting, you're waiting for money to come in. It's just not here yet. You're off timing. Then I use the fast money formula to make sure that that's right. Right. And see if we can solve it. So what I'm doing and I think I was talking with Suresh, and I'm probably way off topic now, but what I do with mine is that instead of a planned program, I have a plan for everybody going into it, and I always have a plan if they don't have a current problem, right? Which means, and I like to do forecasting though in October, because I feel like you got enough time to plan before it starts in January. Some people do it in January. I'm like, well, you missed a whole month. You
Yeah.
missed the whole month of the year, right? Because so if you start in October, you can get everything prepared to make any big changes in January. So anyway, that's how the 2 books will interact, and that's why it's like dumb and tell, right?
Great. Thank you.
Yeah.
Thank you.
All right. And so anyway, yeah, that's the whole thing. Find the problem, identifying the problem, using the technique, and then getting them to take action.
Uh-huh. And how many times has this worked for you?
Every time.
Every time? So
Yeah.
how long did it take you to test this theory?
I've been using it now for over a decade. What I didn't realize is that other people didn't have their own ways of talking to clients. This was a really weird thing, and When I originally started, I built the Clear Path to Cash to teach people how to do the mathematical concepts, right? Just, hey, here's the math to kind of look at a business a little bit differently. And then accountants and bookkeepers says, oh, we have to start doing this, but we don't know how to price it. We don't know how to package it. We don't know how to execute it, right? So I built this other part that's now part of my certification where I teach them how to do that, right? How does it work internally in your world? And once they started using it, they go, oh, I can't get people to take action. I can't, and I said, well, role play with me. And what I figured out is they were more in the tell. They were telling people what to do. And no business owner I know is like to be told what to do, right? That's my business, right? My business, you know, so am I going, oh, that's something I've done naturally because I said there's a combination of state trooper and hoarders. As a state trooper, they taught me this concept called verbal judo. And the whole point of it, the whole purpose was, hey, it's okay to talk for 30 minutes rather than fight for 3, right?
Yeah.
So it's a way to talk to people so that they naturally come to the conclusion and they say it themselves that, yeah, it was wrong, it was bad. So it's in the book, the new book, it's 8 questioning techniques that I used as a trooper, right? That I just continued over because it became part of my life. I did it for 7 years. So you're talking to people like that all the time. So it sounds like natural conversation now. But then hoarders give me a whole different perspective. When they say things like, I think about the conflict right up front. I think about how tenuous it is the first time you analyze a business owner's company and they say, yeah, you know what I'm talking about. You just don't know my business that well. Or, there's something there because you're telling them what to go do and they resistant to your advice. And and I look at that as the first scene in Hoarders as there's the doctor at the door and the person with the disorder at the door and they're facing each other and the hoard is behind them. Everybody can see it. The audience can see it. The person's there. And I'm like going, that's when everything could fall apart instantly. The person could just slam the door and say, I ain't doing it, and shut the door, and it could be a big fight and the whole show's over. Why don't they do that? I'm like going, it's because of what the psychologist says first. After they introduce themselves, hey, I'm Dr. So-and-so, and this is what I do. They'll say something like, hey, tell me what I'm looking at. Right? It's not there's not an accusation there. There's not a judgment there. Hey, tell me what I'm looking at. And they might say something like, hey, well, how do you think it got this way? And questioning people like that gives them a chance to rationalize. It gives them a chance to defend it, right? They get to talk about it and they start to use their words on why it's that way. Oh, well, these are like 5 crafts and I've got this show I'm going to. So I kept all that from 15 years ago so I could do this show next week. They start to talk about it and it doesn't make sense. When you start to talk to somebody about the rationalization, okay, well, when's the show? How many shows have you been to the last couple of years? That's the same questioning techniques from being a police officer. If you watch Cops, they're just asking a series of questions where all of a sudden the guy's just like, oh, yeah, it doesn't make sense, does it? And so I don't tell people what to do. I ask the question so that they say what it is, what the problem is. The first thing I want you to do as a client of mine is to identify the problem yourself with your words. Because if I say it, you can argue with me. If you say it, who are you going to argue with? Right? You said you had an inventory problem. I'm just helping you solve it. That's why I use the app too, because the app takes it out of me. I'm not saying you did anything wrong. These are the numbers. The numbers are the bad guy, not me. All we did was type it in. You told me that the numbers were, I typed them in. This is what came out.
Mm-hmm.
And it solves so many conflicts. And that's what I'm saying. It's about commitment, not compliance. That's what I think the biggest shift in like the accounting world is to go to advisory is you want the person sitting across from you talking not only 70% of the time, you want them to identify the problem. And then you go, well, how do you think we can solve that? I know the solution, but I'm gonna say, hey, what's some ideas? We could do 3 or 4 things and I'll throw out like 3 or 4 things. What do you think would work best? Oh, I like this one. Okay. Then we work on that one. So it's just a different mindset on the way I advise versus I think some of my peers do.
Well, that's extremely interesting because it always helps if if somebody asks me how I'm feeling, what's going on, what made you act that way, or something like that. it does make you have to look at yourself or look at the situation and try to figure out yourself, because you got to answer the question the person asked you. So you're forced to look at it from their perspective. Like, what am
Right.
I looking at? Well, I see a mess, but why did you create this? Or
Yeah.
I don't know. I'm rambling, but
No, but one of a powerful statement coupled right onto that one is to go, hey, what do you think would happen if you did that? What do you think would happen? I know what will probably happen, but if you say it, I go, yeah, I think so too. But what about this? And if they miss it, I'll go, well, what about this? Do you think if you did something X, Y, Z,
mhm.
that would be helpful or hurtful? Which way do you think I would run? And those simple it to me it seems simple now, but I realize that that's a skill, not a natural occurrence.
Yeah, it
Right.
is. One of my favorite lines from Dr. Phil is, well, how's that working out for you?
Yeah. Right. Yeah. And that one, sometimes that's a smart aleck way of
Yeah,
saying it, but
yeah.
hey, how's that working? What do you think? And
Uh-huh.
that's why I add, is it helpful or hurtful? Which means I'm not trying to judge.
Right.
Saying, what do you think? Did it work?
It's not working. Okay, let's try something different.
Yeah, scrap it. Let's stop spending time there. Yeah.
That's great. I thank you, Mike, for your entire series. I look forward to seeing you in a couple of weeks. Um, it's it's been valuable, and I have realized how much I don't like to math, but I need to work on that. I shall work on that. So, um, well, let me share my screen here, and we will talk about our upcoming webinars. Um, let's see. I don't think you're getting. Are you getting the slide?
Now we're getting your Word document currently.
Oh, well, we don't want to do that.
Yeah.
Let's see. Yeah, I want to look at this slide with our upcoming webinars.
There you go.
We have lots and lots going on, and all you have to do is actually use the QR code in the upper right-hand corner, and you can schedule yourself for any webinars. Or that's where you can also get information on us and how to get our contact information, how to schedule an appointment, or also look at some of the resources we already have on our website. And I need to thank our benefactors. We are grant funded, and because of that, I want to give a big shout out to the Small Business Administration, to the state of Texas, and to North Texas SBDC regional office, as well as our host institution, North Central Texas College. I thank everybody for joining us today, and we look forward to seeing you next time. Mike, see you in Atlanta. It'll be great.
See you soon. Hey, thank you very much. Really appreciate it.
Thank you.
All right. Take care, y'all.